Usually in this channel, I cover the advantages of tokenization for businesses raising capital. In this video, I will talk about benefits for investors and how they function. I will cover more nuances than an average article does on the same token, featuring some non-obvious aspects. This video will help investors in understanding why investing in tokenized securities and help businesses understand how to pitch them to investors. My friends, welcome to Stobox Insights, a video series about capital raising and financial innovations, brought to you by a professional consulting company. Visit our website to learn more about our products and services and how they can benefit your business. Let's go! Unlike regular private or public securities, located mainly on your brokerage account or existing in the form of government registered records, tokenized shares are programmable. They are actually smart contracts which can interact with other smart contracts and other objects located in the blockchain, in particular decentralized finance protocols. Due to this, you can use various instruments to increase the profit above the one you are already acquiring from the mere investment in the asset. There are plenty of ways to earn this additional income, and they depend on technical integrations and implementation of the token. Some issuers, for example, provide an option of staking, a chance to earn extra income on your tokens. It can also be liquidity mining, depositing your tokens into the liquidity pool, thanks to which you will earn additional income for facilitating the transactions with the given token. You can also get a stable income by putting them into the credit protocols so that it's possible to take a loan in your tokens. Alternatively, you can even switch sides in this matter and use the token as collateral to get a loan, which can be further invested to earn additional yield. If you're not familiar with the protocols and terms I'm using here, take a look at our video on the topic of decentralized finance. Long story short, the possibilities of using securities tokens to increase revenue are almost countless, whereas classic finance doesn't allow that. Therefore, tokenized securities are superior compared to conventional ones. Enhanced liquidity of tokenized securities is often spoken about very vaguely as some kind of magic which doesn't add credibility to such claims. But in practice, it's very clear and it's enabled via three distinct mechanisms. The mechanism number one is the diverse pool of investors. Instead of working with only one or a couple of big investors, businesses can have at the same time several larger ones and hundreds of small investors. The investors may come from different jurisdictions or offer different investment amounts. This increases the potential number of counterparties for a transaction, therefore making it easier to trade and increasing the trading volume. The second mechanism is a more straightforward transaction process. A convenient digital form in which your securities now exist eliminates the red tape and lets you complete all the necessary procedures faster. You can sign documents or transfer your tokens in a blink of an eye. Due to simplicity and automations, transactions also become cheaper, so the minimum trade amount is reduced. Thanks to this, they are also completed more often. Thirdly, within decentralized finance, there are systems making trading of private securities possible, namely automated market-making protocols. The AMM systems enable trading the company shares within the liquidity pool, which is an excellent alternative to stock exchange or a P2P private trading. If this video is useful or insightful for you, please like it to help the channel grow. Also, please share it with your friends to whom it can be interesting as well. This benefit applies primarily to individual investors. For a long time, they weren't able to invest in assets like commercial real estate, as those objects have always been utterly expensive, or invest in private companies. This meant inability to diversify their portfolio or invest in great asset classes with attractive returns. Due to the rise in efficiency, tokenization reduced the investment threshold, opening access for retail investors. Thanks to the transparency of blockchain, investors can monitor the performance of their tokenized securities at any time. The technologies that will enable collection and processing of all the transactions of a company are developing fast. Therefore, soon the reporting and auditing will be completely automated. Thanks to such progress, investors will be able to make better financial decisions related to exit, utilization of tokens in DeFi protocols, and oversight of corporate management. Thanks to this reporting, the investors' chance to get scammed is significantly reduced. The problem crypto investors face every day is that most crypto instruments are very risky and volatile. Such assets are great for making money, but are bad for preserving your earnings. Traditional financial instruments don't suit crypto investors. Firstly, they simply don't trust them. Secondly, the returns on saving instruments in traditional finance are very small and barely cover the inflation if you are merely opening a bank deposit. Respectively, crypto investors need a way to store value in cryptocurrency. There are two ways in which this can be done now. The first is investing in major cryptocurrencies like Bitcoin or Ethereum. From a very long-term perspective, their volatility doesn't matter and overall they tend to appreciate. The problem with this strategy is that it's way too long-term. Even major cryptocurrencies may fall at 50% in the medium term. This reduces the flexibility in cashing out your money whenever you need it and negatively impacts your portfolio overall. It's also bad from a psychological point of view, as people are emotional in their essence and some may sell under the pressure and fear. On a side note, we have a video on making sound investment decisions, which I encourage you to watch. The second option of storing value in crypto is stablecoins. The problem here is that stablecoins do not generate any return by themselves. Of course, you might stake them in some liquidity pools or credit protocols to get an income, but it also creates additional risks. Not every stablecoin is fully backed by cash or safe assets. The protocols for staking or farming are subject to technical, legal, and liquidity risks. All of the above doesn't matter. Security tokens, on the other hand, represent real-world assets that have historically proven their systematic profitable growth and safety. Examples of such assets are land, real estate, natural resources, etc. It's a golden niche for investors desiring to keep their money safe by bypassing traditional finance. I hope this video gave you a clearer understanding of how tokenized finance can benefit you as an investor. If you would like a more in-depth consultation, please reach out to us and leave a request on the website stobox.io for a free 30-minute consultation with our expert. Also, don't forget to subscribe to the channel and turn on notifications to not miss our other videos on the topics of capital raising and innovations in finance. Stay tuned and see you in the next episode.